So here's the thing. Most investors are doing this with their money, just putting it right back into liquidity pools. Some investors are doing this, taking it and putting it in their bank account. And very few investors are doing this, where they just put money in hodls. I'm here to tell you that that is not the way to do things. And I actually have worked with multiple people with over $1 million in their DeFi portfolio, and they have more advanced strategies than this, of course, right? But the strategies that they use can be used on any level of capital, whether it's 25 grand, whether it's 50 grand, 100 grand, 250, 500, hey, even 10 million, 50 million, 100 million, so on and so forth. The strategies are the same. The execution is different, but the strategies are the same. So today I want to walk you through the exact strategy that I used and actually implemented into a portfolio that is generating $4,000 per day with $1 million in capital just last week. And it's more of a blue chip portfolio. But at the same time, I want to show you what they're actually doing with that $4,000 per day. Because $4,000 per day is a total of $120,000 per month. And I think a lot of us would be able to live on $120,000 per month or substantially less if we got put in the situation where we were making $4,000 per day. The majority of us would realize that the yield that we were generating is a great, amazing yield, but ultimately we would want to generate more over time and build our financial legacy. So let me show you how we do that with decentralized finance. And it's through my proprietary strategy called the DeFi Flywheel, where essentially you are allowing your portfolio to grow on its own. You are building bags and hodls, you are cashing out to live, and of course, you are reinvesting back into liquidity pools. It's a pretty simple concept. It's just the actual execution is what most people lack, and the actual strategy in place is what most people have trouble with. And we're going to be using a software today to actually calculate this flywheel and see potential returns behind it. But I want you guys to open up a whiteboard, right? And I want you to put a couple different things on your whiteboard. We're going to go through this together. And if you don't have a whiteboard, do a piece of paper. If you have a physical whiteboard, do that as well. Or just go to a free website, Web Whiteboard, and call it a day. On your whiteboard, I want you to format it like this. You have your liquidity pools, your LP income, your hodls, and your cash outs, where you put money in your bank account, right? And cash outs can also be considered stablecoins and whatnot, but format your whiteboard like this. And once you've done so, we're gonna whip out a pen and we're gonna start to draw. Right? So we're going to essentially figure out where this money is going. And granted, we can do this on a more micro level if we really wanted to, but right now we're going to be doing it on a macro level. We're going to be looking at it from an overall portfolio perspective. Then, and only then, we are going to dive into it on a micro level. So obviously our liquidity pools are producing us income. If they're not producing us income, well then you're probably not in any good liquidity pools and you should probably reassess your strategy. What are we doing with that income? Well, I personally think that a portion of it should be allocated back to the liquidity pools to grow the liquidity pool portfolio. So that way, if we're making $3,000 one month, maybe the next month we make $3,300 and we grow the portfolio over time, right? Another portion of it should be allocated right into hodls. And the reason why is because there are going to be instances where you're in an asset, an altcoin say, and it's paired with ETH or it's paired with SOL ultimately. And this altcoin, we're going to call it XXX, right? Ultimately goes up, let's just say 50% in a day because it's, $50 million market cap. Alt season is here. It's up 50% in a day. You go to check your portfolio, you're like, my gains are going to be great. And guess what? Your gains are like 10%. Why? Because all of XXX was sold into SOL or ETH basically. You have a bunch of divergence loss. You missed out on the fact that XXX just went up 50% in a day. And you want to know what you got instead? You got maybe 2% in that day from yield, and you got 10% in price appreciation. And the last time that I checked, 12% is less than 50%. So that's exactly why we build hodl bags. So we don't end up in situations like this. Or maybe we do end up in situations like this. Our liquidity pools go out of range. We have a lot of divergence loss, but ultimately we have built a hodl bag of XXX to the point where, hey, that XXX was accumulated for free, and now that XXX is up 50% and we have seen substantial returns. That right there is why we build hodl bags. And then of course, we have to live, everybody has to pay bills, and extra money is always great. So we cash a portion out, or we put it in stablecoins, and we eventually use stablecoins to invest into hodls, or even invest back into liquidity pools. So you guys can kind of see where this is going. This LP income is a vehicle that is allowing us to grow our overall portfolio. It is allowing us to go from being at, say, $100,000 one month to now having $110,000 the next month to now having maybe $122,000 the month after that, and ultimately grow our portfolio and flywheel its growth. Now, what exactly is a flywheel? It's essentially something that grows on its own and repeats actions consistently based on previous actions. So what that would look like in this instance is we would have our liquidity pools, which generate us income, and that income allows us to build our portfolio, right? And building our portfolio allows us to deploy back into liquidity pools to make more income, basically. It flywheels the growth, which means that our portfolio value is going to begin to come exponential. Instead of it just being a straight line, linear like this, like most people's portfolios, it is exponential. It starts to grow over time, and we can set ourselves up for life if we take advantage of this industry while the returns are high. And by the way, guys, I have done this with over 180 different people in the past. I know that this strategy works. It's the same strategy that I implement into my portfolio that has allowed me to consistently grow my portfolio without always having to inject more capital. Yes, there are some months where I'm like, hey, let's throw some more capital in from the bank account and build the portfolio. But then other months, this income is building the portfolio for me solely, and I'm consistently adding more capital strictly by using this income. And no, it is not a basic strategy where I just take this income from liquidity pools and put it back in the same liquidity pools. That's not how you balance your risk. That's not how you grow your portfolio. That's how you end up with a bunch of divergence loss, and you're stuck over here in an out of range position with ETH, XXX token, while XXX token just pumped 50% in a day and you have no exposure. Truth is, in a bull market, it's easy to make money. It's harder to make sure that you're making the most possible money, but it's easy to make money. What are you going to do in a bear market? So you have two options here, right? And these two options are pretty simple. Number one, this bull market, you continue to do what you think is the best strategy in your portfolio, and you think you're an expert because you're making money. Truth is, everybody makes money in a bull market. And then ultimately, you're in a bear market, and then all of a sudden, you are not prepared. You are losing money like crazy. You did not sell any assets. You did not take any profits. You thought you were an expert over here. So when the bear market comes into play, you also think you're an expert, but now you're just losing a ton of money, right? You're not prepared. Or you could take advantage of this information that I'm giving you, build out a flywheel. So when the bull market ends, you are prepared for the bear market, and you already have advanced strategies up your sleeve right here. So that way you can execute on them as soon as the bear market is in play, and you can start to make money in the bear market as opposed to your portfolio looking something like this, basically. A little bit of a bell curve. You ride it all the way up, you ride it all the way back down, and you have absolutely nothing to show for it at the end of 12 months or so. And by the way, guys, I will help you do this if you want the help. Otherwise, take advantage of the free information on YouTube. There's tons of it. But if you want to streamline things and you just want to get started right away and start building your own flywheel in a professional manner with people that have done it with over 180 people in the past, hit us up. There's a link right below this video. You guys can check out, number one, the software that I'm about to show you, but also there's an application right at the bottom for a free portfolio audit, and you can get an audit from our team, see if it's a good fit, and potentially work with us. Simple as that. And I'm not going to push it on you. If you want help, we're here to help, basically. But with that being said, I want to dive back into this flywheel calculator. Let's take a look at how this could work. Say we have $50,000 of capital, right? We're going to enter our initial capital at $50,000. Now, a lot of people think, hey, I need to put it all into LPs because ultimately LPs are what produce me income. HODLs don't produce me income. HODLs have growth over time. There's a reason why traditional investors invest into real estate. Real estate produces cash flow, yes, but it also builds equity. And while your LPs do the same, there are going to be instances where that XXX token goes up 50% in a day. You're stuck with a bunch of divergence loss, and your friend's like, man, like you must be rich. You just invest into XX token, and you're sitting over here up 10% when you could have just invested into Ethereum and had better returns, right? With that being said, we always allocate a portion to HODLs, whether it's 20%, whether it's 10%, or whether it's like 60%. Always keep some in HODLs. The investor that we worked with last week to deploy $1 million into DeFi, they had roughly $30 million in crypto, and they had $1 million in DeFi, right? That is a lot in HODLs. And they're going to scale up their DeFi portion, yes, but they're going to get their strategy right first, and they're going to deploy nowhere near $30 million in DeFi because it's important to have both. And as you get more money, you take lower risk. So let's just say we want to go for hyper growth at the very start, or we think the market's consolidated, and so we allocate 30% to HODLs, 70% to LPs. And guys, by the way, we can borrow against these HODLs at a future date, inject that into LPs. That's a strategy for another day. But our income allocation, where's this going, right? This is where we break down that flywheel, right? And we have some going to HODLs, some going to cash out, some going right back to the liquidity pools. So let's dive in. Of that, how much is going to HODLs? I personally do about 30% in HODLs right now because, again, we're in a hyper growth phase. We want to put a lot of it into HODLs. I do about 15% cash out. Really, my cash out is just putting in stablecoins, holding those stablecoins until there are market dips. And then the rest of that is going to go into liquidity pools. So with that being said, we have 100% allocation across the board. That's That's right. We move on. How much APR are we doing? I like to assume 10% a month. That's what I've been doing in my portfolio. I'm doing that pretty consistently. So let's assume 10% a month. How much are these assets appreciating on a monthly basis? And by the way, this is compounded growth. So if it's say $10,000 produces say $200 in appreciation, you now are assuming the next month it's that $10,200 that's going to appreciate instead of just the initial $10,000. So keep in mind, compounded is very different than year-over-year growth. And then if we take a look at divergence loss profit margin, this is if you are beating holding in the market in your strategies. I typically like to put this at 70% because that's what I do in my portfolio. You might be doing 60%. You might be doing 90%. Plop your wallet address into Metrics Finance and you'll be able to find out this information. That basically tells you if your strategy is working or not. If it's better to take a bunch of risk and invest in these liquidity pools and do a bunch of management, or if it's better to just chillax, hold, and ultimately end up with more money than your liquidity pool strategy. Because the last thing we want to do is invest into liquidity pools and then spend 10 hours per week or 5 hours per week even. And then all of a sudden, it is better to just hold Ethereum or hold Solana or hold Bitcoin, right? We don't want to be in that situation. With that being said, we can now visualize our portfolio growth over time. So you can see that we start with that 50 grand, and after the time span of 12 months, we're at 110 grand. Our monthly income has scaled from $3,500 per month all the way up to $6,500 per month. We're pulling out more in net income, and you can see our flywheel, which is 120% APR, producing income. 55% is going over to compounds, 30% is going over to hodls, and 15% is getting cashed out. Pretty simple process. So now we can start to do that on a micro level. And I actually have another software for this. This one I'm not going to share. And the reason why I'm not going to share this is because we do spend like nearly $10,000 on internal tools that we provide our legacy clients access with. So that's just one of the many benefits of working directly with us. You have the tools at your disposal. Yes, we have public softwares like Metrics Finance, but that's just a glimpse of what we offer behind the scenes. But with this tool, and remember, you guys can do this on a whiteboard, on a piece of paper, whatnot, right? You will take your liquidity pools and you'll say, hey, we got a sold USDC pool where maybe we started with $20,000 of capital. And that right there is doing a 120% APR. Our monthly appreciation is capped, and maybe you're doing 1.3% a month because remember, our SOL is going to be sold into USDC as the price moves up. In a divergence loss profit margin, we probably have none on this, right? We're probably in the negative actually. But we don't care because this is an income position. A lot of the crypto to stablecoin liquidity positions, those are focused on income. Whereas you also have the crypto to crypto, which are more focused on growth. But that sold to USDC is going to be producing income. We're not going to use the net income because again, we're not really worried about divergence loss because it's an income position. And ultimately $20,000 at 120%, it's $2,000 a month. Pretty good. A portion of that is going to be compounded. Another portion of that is going to go over to a hodl in SOL token. And perhaps we have no SOL at the very beginning, right? And we are doing, say, 7% APR on the SOL that we generate because we can stake SOL for about 7%. And perhaps this is 2% a month in appreciation because it is just full-on SOL. It's not SOL USDC we're getting sold, right? Well, typically the fees that we're generating, so this $2,000, about half of that, and I do say about, will be in USDC, and the other half of it will be in SOL. So maybe we keep the SOL portion, and then we compound the USDC portion. So we have about 50-50, and we can build our portfolio over time just like that. This is a simple flywheel for getting us exposure to SOL. The next thing that we can do is we can now introduce another position, something like SOL to render, and perhaps we start with $10,000 of capital here. It's doing about 90% yearly, and then we're doing about, say, 2% per month in appreciation, and maybe we have a 70% divergence loss profit margin because SOL and render are correlated, right? Well, we have income that's coming in from that position, and ultimately, this is going to be a little less income than what's being generated from that sold to USDC, roughly $750 per month. We would be wanting to use our net income because ultimately, our net income we're focused on in growth positions, whereas net income we're not focused on really in the income-based positions. But then we also have a hodl of render, which we don't have any capital in. We're not earning anything from staking it, right? And perhaps this has 3% per month in appreciation baked in because render is a solid asset, probably going to outperform SOL, right? Well, we're taking some of that and we're putting it in render, and then we could also be taking a portion and putting it right back into the position. Or we could switch things up a little and we could actually say, hey, like maybe we don't want to compound the SOL to USDC. Maybe we want to use the SOL to USDC as a vehicle to build up our SOL render position. So perhaps we have a compound that is going right back into the SOL render position just like that from here, building up this bag, and that's the USDC portion, and that gets connected over here. So $1,000 a month is being compounded in SOL render, building up our position over time, And then we also have another half or so. Maybe this is the SOL half that is coming right over here in SOL render. So maybe 50% goes into render, 50% goes into SOL render. That brings our monthly compound up to roughly 1262. Building the position. We're building bags in render, we're building bags in SOL, and ultimately we're compounding a portion while still having a portion to build the bags in, basically. So that's exactly what you can do through softwares like this and tools. You could see the growth over time. And again, you can do this on your own with your own little whiteboard. That's completely fine. That's what I started doing this as, and I got annoyed with it, having to do these calculations and these graphs by myself. So ultimately, I just had a developer team build this. And you could also see your income over time going from 3,000 to 3458, right? Because you are compounding a portion and you are building the bag over time. So again, just compounding straight back into liquidity pool or just cashing out or even just putting it all in hodls, that's not the way to go. You need a mixture of all three of them, and you need to do it strategically. You shouldn't just be like 30% goes here, 50% goes here, so-and-so goes here. You can do that from a high level, from a portfolio level, but you should ultimately drill down into the positions that you have and be like, I'm taking the SOL portion that I generate or the SOL portion of the fees, and I am putting it here. I'm taking the render portion of the fees, I am putting it here, and so on and so forth, basically. Guys, if you enjoyed today's video, make sure to drop a like, subscribe, notifications, turn it on. And of course, if you guys want to check out that free tool that we have from the portfolio level, that's going to be linked right below this video. Again, if you want help, you want to just expedite things, not have to go through the process of trying to figure this out yourself and making mistakes, you can work with us, get a free portfolio audit with one of our team members. We'll see if it's a good fit. Go from there. I hope you guys enjoyed today's video. I will see you guys in the next one, and peace out.